Imagine two people standing on the same street in Sydney. Same age, same job, same haircut, even. But one of them retires at 58 with a paid-off house and a portfolio throwing off passive income every single month. The other one is still working at 70, hoping the pension covers rent. The difference between them was never luck. It came down to what happened at every single stage of their investing journey, starting from the very first dollar they ever put to work. By the end of this video, you will know exactly what your life looks like at every portfolio size in Australia, from having nothing saved at all, right up to becoming a genuine millionaire. And I promise you, the middle stages are where almost everyone gets it wrong. Here's why this actually matters. Most Australians have no idea what a realistic wealth journey looks like. They see influencers flashing six-figure portfolios online and assume they are years behind, or worse, that it's simply not possible for someone earning a normal wage. Neither of those things is true. But because nobody breaks this down honestly, people either give up before they start, or they panic and take reckless risks trying to catch up. So today we are mapping the entire path, stage by stage, so you know precisely where you stand right now, and more importantly, what the next stage actually requires from you. Let's start at the beginning, because this is the stage almost every investor forgets about once they move past it. $0 invested. This is not a failure. This is simply the starting line. At this stage, your biggest asset isn't money, it's time. In Australia, compulsory superannuation means that even someone who has never opened a brokerage account already has money growing for them in the background, usually somewhere between 11 and 12% of their income, depending on their employer contributions. Most people don't even think of super as investing, but it absolutely is. The mistake at this stage is comparing yourself to people further along the path. Comparison at $0 is pointless. What matters here is building the habit of putting money aside before you even have a strategy. Now let's move to the first real milestone, somewhere around $1,000 invested outside of super. This is where most people quit before they even begin, because $1,000 sounds small. But here's where things get interesting. The psychological shift that happens here is enormous. This is the point where you stop being a spectator and become a participant. You open a brokerage account, maybe through one of the low-fee platforms popular with Australian investors, and you buy your first exchange-traded fund tracking something like the ASX 200 or a broad global index. The dollar amount barely matters. What matters is that you now understand how buying works, how dividends land in your account, and how it feels to watch the market move with your own money involved. Most people who reach this stage and stay consistent never go back to having zero invested again. But here's the mistake that kills momentum at this exact point. People treat their first $1,000 like it needs to be perfect. They research for months. They try to pick the one stock that will make them rich, and they freeze. The truth professional investors understand is that at small amounts, the specific investment matters far less than the habit of investing itself. Getting started beats getting it perfect every single time. If you're finding this useful so far, take a second to hit like and subscribe, because we're about to go through every stage right up to millionaire status, and you'll want to see exactly where your next milestone sits. Let's talk about the $10,000 stage, because life genuinely starts to feel different here. At this point, dividends and distributions become noticeable. If you're holding a diversified portfolio of Australian shares, franking credits start to matter, meaning some of the tax already paid by the company gets credited back to you. Most Australians have never heard the term until they reach this stage, and suddenly it becomes one of the most valuable parts of their strategy. $10,000 won't change your lifestyle. You still go to work. You still budget carefully. But something shifts internally. You start reading finance news differently. Interest rate decisions from the Reserve Bank suddenly feel personal instead of abstract. Market dips that used to seem scary on the news now feel like something you actually understand, because you're watching your own numbers move in real time. Here's a mistake almost everyone makes around this stage, and it's rarely talked about. People start checking their portfolio every single day. Daily checking creates emotional whiplash. You'll see gains that excite you and dips that panic you, and neither reaction helps you make good decisions. Professional investors, the ones managing serious money for a living, check portfolios far less often than beginners assume. They understand that short-term movements are noise. Long-term trends are signal. Now we reach $50,000. And this is where the story starts to genuinely diverge between people who build wealth and people who plateau. At 50,000, your portfolio can realistically start generating a few $1,000s a year in dividends and growth, though this obviously depends on market conditions and asset allocation. This is the stage where many Australians start asking a dangerous question. Should I take on more risk to speed this up? This is exactly where the biggest mistake in the entire journey tends to happen. People who reach $50,000 through patience and consistency suddenly abandon that strategy, chasing faster returns, jumping into speculative assets they don't fully understand.